Good morning, everyone. Welcome to today's session, which is Fundamental and Technical Analysis for Idiots, and it is part 1. So here two clarifications. Fundamental and technical analysis is used more to lure people to a serious discussion. However, this being an introductory section, we may have to deal with many other background information here. So today we will do just bare minimum justice to fundamental and technical analysis and have further sessions before. That's why this is part 1. There could be some part 5 to part 10 before we exhaust this topic. And here we have mentioned as for idiots. By idiot meaning it is a beginner or a dummy. Basically, in order to learn, we need to empty our cup. We cannot come with a sense of haughtiness saying, I know everything. So what the hell you are going to talk about? So even if you know today, please empty your cup and be an idiot, open to take the information. And the speaker also is another idiot. So we are all in the same boat. By by idiot, I don't consider myself an expert. I am also a fellow student, and by teaching, I hope to learn faster. So that is the uh, purpose. Today's agenda, I will take 10 minutes for introduction, then try to zoom through the background information for 20 minutes, another 20 minutes for Indian stock market background and the context. Then I will talk about fundamental analysis and technical analysis, maybe for 20 minutes. And I primarily, in fundamental analysis, try to go through a company fundamental using screener. Then in technical analysis, I will try to dabble with some of the graphs or the charts and use certain indicators and at least share how I have been using some of those indicators. A detailed session needs to come later. Then there are some references given for further learning, and we may have some 15-20 minutes for the question and answers. So let me talk about the context of this series. This series of talks are not only not given only by me; it's also by many other people in our community. So this is a community level activism because we need a peer level investment and trading communication as well as a learning enablement, and we need to learn fast because there is so much to learn. It is like getting a black belt in karate while you have just joined with a white belt. So much learning needs to go, and earlier we learn, faster we learn. It is better for our objectives. Then, because we are working as a team, there is an optimal pace to our maturity and well-being by helping each other, because different people will learn different things. Different people are experts in different things. Different people are experienced in something. So there will be some voluntary work from various angles. And instead of one person doing everything, let us put our heads and hearts together and do a better job. And because we are not alone in this, the journey we will have also can have maximum fun. That is the background. Now, some salient points here about this subject. Say, one can achieve a PhD level expertise in any subject within 3 to 5 years, depending on the complexity and the effort. Similarly, a doctor takes 5 to 7 years to become a graduate level degree before practicing. Similarly, in stock market, we need that level of learning and expertise to make money. And typically, what happens is someone practicing medicine without a qualified degree is called a quack, and that can be dangerous to patients, and patients can get killed. Similarly, in stock market, if we behave like a quack, instead of making money, we will be losing money. Therefore, the learning objectives are not optional, it is mandatory. So we need to put the time and efforts. There is no shortcuts in this. So we need to learn and we'll transform, starting as an idiot, we'll transform to be an expert. There is so much maturity that will come, and there will be mastery because of the learning and transformation and maturity. Eventually we will become a master. So I would say 5 years worth of work we need to put it. Depending on how much time we spend, maybe we'll con, you know compress it within 2 years, or it may take 8 to 10 years, depending on how much time we can give. So anything we do in our life, there is a cost and there is a price. See, the difference between a cost and a price is a margin or a profit, someone else is going to make. Here also, we need to make sure that the price we pay is very close to the cost, and we look for reducing the cost of learning and making money. So that is the reason these kind of classes are very important. One can pay money and take expensive courses, but I think today with web resources and a community like this, we can learn without having to spend that kind of money, because we need money to make money. So we don't want to spend lakhs of rupees, learning just for learning. This journey can be fun while it demands a lot. So why I would say is that, let's say being a beginner, we may be like just a germinated a mango seed, whereas you will see an expert like a mango tree. So if we go through the journey like that mango tree, eventually we'll also become a mango tree. Whereas a mango tree can look at us and say, look at the journey ahead, which I have already completed. So there is a mutual benefit in both stages. So let us not ignore the benefit we have uh, by being a beginner or a journeyman in this journey. So we need to have a level of purpose, a clarity of vision, some strategy and plans as we go. But we are starting in a very humble manner. So these things change. So there is a level of reflection and meditation at every stage of our journey. We need to work hard, not just aiming high. We have to work smart. There will be setbacks. So, but there could be some winds. While some of the winds could be headwinds, some can be tailwinds. So there will be ups and downs, but the journey is important. It's like a story of tortoise and a hare. The race was won by tortoise, not the hare, because hare was uh, way too overconfident and slept. So same thing happened here. So anybody who is trying to get into stock market, the in terms of vision, uh, I would say Rakesh Junjunwala is a success story in Indian context. So, he started small, around 35 years. He made such a huge success. You can read about his story. Only setback he had was he ignored his health and therefore died bit early. But his success as an individual investor is phenomenal. So I would say that his story should be an inspiration for all of us. There is an opportunity for us to become another Rakesh Jinjunwala if you are willing to the put our head and heart into such a path. One does not know enough to plan everything, right? So at any given time, we are having half knowledge, half baked information or misleading information, confusions. So we cannot really go in a very linear fashion or a predictable fashion like a scientist or an engineer. Okay. So it is a fuzzy path. So there is so much of uh, science and technology as much there is artistry. There is fuzzy logic. There are a lot of opportunities and risks, and the last point is escape velocity. what do I mean by escape velocity is to send a rocket to the sky. A rocket has to gain a minimum escape velocity. Otherwise, any number of effort, it won't give results. Similarly, when it comes to making money in stock market, we need to have a minimum level of escape velocity in terms of exploiting the opportunities, managing the risks, and conserving our capital, and ultimately creating wealth. This escape velocity is something we need to size it and understand it, and then aim it and accomplish it. Because we are hoping to become a closely knit learning and performing community, there are multiple roles each one of us can play. Not only being a student, we can be a teacher. That's what I am trying to be today. We can be mentor to each other. We can be activists, getting more things done for our own benefit. We can be a cheerleader, inspiring others, or encouraging others. We can be a companion if someone needs a discussion or some support. We can be a friend. So this is the background of our journey, and today's session is in support of that. So now I'm actually getting into the main part of this session. This is stock market basics. So this I am supposed to cover in 20 minutes. So I don't have time here, which is a disadvantage. Just hold on. Okay. So let me talk about what we need to know. I am not going to teach everything today. We need to understand the nature of money. There are some good books about understanding money. So we need to manage it. We need to learn to love it, respect it, enslave it. We should not become a slave to money, but money should be enslaved to us. Money is to serve our life. Life is not to make money. Money is to make our life. So we need to make sure that life is more important than money. In India, always the purpose of life is defined in four purusharthas: artha, kama, dharma, moksha. So here the money is useful for in all four. Artha is wealth, kama is pursuing your desires, dharma is the optimal way of life, moksha is the ultimate liberation. So money is very useful in for all four of these. Then India talks about yoga, which is integration of everything. So here again, money is quite a lubricant here also to integrate all aspects of our life towards these purusharthas. So when we talk about money, we need to understand inflation. Inflation is a built-in quality of our money system, and typically the bank deposit interest we get is comparable to the stated inflation, but actually uh, the inflation could be much higher because certain costs of living go up very fast and they are not accounted properly in our inflation. So we should always assume that even with a bank interest of 8%, we are losing money year on year. Therefore, there is a need to make money with our savings better than inflation rate. That's the one of the lure to come to stock market, because typically in India stock market at the index level, historically, indices have achieved an average of 15%. Good mutual funds can achieve anywhere between 15 to 25% year on year over multiple years. And India is now very much poised to become a developed country through next 20 years. So there is a very good chance that India will grow with a much higher rate, maybe hopefully double digit GDP rates in coming years, which means that our stock markets could do better than 15%, maybe 20% in coming years on an average. And those who participated in the stock market since 2020 have seen Indian market returning something like 30 to 40% year on year in the last 4 years. Right now we are going through some kind of a correction, but that will get over. India will come back to such attractive levels of returns, at least post election. So money management is a skill we need to learn. It's an art. Then we need to understand risk management. See, risk is not only in money, risk is in life also. Risk is there in life, it's in relations, it's in every endeavor we take. So here also risk management is an important thing to understand. Risk management is like learning to use the brakes in the car. Imagine you are given a car with no brakes. You will struggle to drive because you are afraid to go in high speed, because you don't have a way to stop the car or slow down the car if there is no brake. Similarly, if you need to make good money, you want to be very aggressive in your investment, your risk management also needs to be very aggressive. So this is an important point. So along with the risk management, we need to go for all the opportunities that are there in the market. Of course, we need to pay for the taxes for the money we make. So that also is an important understanding. I'm going to just give a overview of fundamentals. We don't have time to get into details. If you don't understand anything in this, you can always come back to the uh, internet and learn all this. We need to have a good understanding of how the economy works. The economy works at a national level as well as in the international level. Today, it is a global economy. So, what happens in America influences India, and what happens in India influences America. So, then we need to understand the global commerce. The some of that we'll understand today itself. Then we have a definition of industries, sectors. Actually, it is sectors followed by industry. Then government policy decisions will influence the stock market. Then there are regulatory bodies like RBI or SEBI. We need to understand. Then we need to understand the scope of investments, the return of investments, and the risks. So when it comes to the stock markets are anchored primarily by the underlying business. These businesses are represented by company who float stocks. Okay, so there is a value chain around the businesses. There are supply and demand chains. There is competition. Then there is management and leadership. There are a lot of uh, peripheral agencies like universities, R&D centers, rating agencies. Uh, then middlemen. In investments itself, there is an investment landscape of that it could be investment uh, bankers, it could be brokers, it could be mutual fund asset management companies, you know, uh, many other supporting companies like custodians, rating agencies, etc. So so all this landscape is something we need to master if we get into money making. There are change drivers that influence the stock market. It could be policy change, regulations change, socio-economic, political, technology changes. For example, today we have Aadhaar. So Aadhaar is linked to our phone number, and our phone is today a smartphone. We have apps. So as a result, today we have become extremely empowered with high productivity. A lot of things happen through our phone. A lot of document related bureaucracy is simplified. So this changes our lifestyle also. Today we use WhatsApp. Today we are using Zoom and talking to each other. So we are not requiring to go to a hotel or a restaurant and group together and discuss today. Is happening. So all these changes our investment landscape also. Then there are ecological changes. which influence business changes. Like today, Bangalore, there are some water shortages that are even impacting some business plans in Bangalore. And certain events happen. Events may be related to some deaths, wars, or some good events also. All this we need to be aware. Going further, we need to have a good understanding of financials. What is a revenue, what is a tax, what is a profit, shareholding capital, enterprise value, shareholding patterns, then valuations. All that need to be learned. The valuation, perceived valuation versus the intrinsic valuation. There are a lot of learning here. We'll get into details as you go. Stock price is different from the intrinsic value of a company. See, stock price is decided by a stock market. Primary platform to decide that is the exchange, where the stock buyers and sellers exchange stocks, right? So, if someone is willing to pay the price of a seller, then the stocks can be exchanged for that price. So you in a stock exchange, you will always see the buy side and the sell side price, and there is a negotiation. And when these two match, then only the stock sale happens or a purchase happens. So this is called a stock trading. Now there are two words we use: trading and investment. Please understand these two go together. In order to trade, you need to invest, and in order to invest, you need to trade. So these two terms are used in a in a in an ex, in different contexts. They go together, and there are loaded meanings. For example, if someone is investing for a long term, it's called investment. If someone is investing for short term, it's called trading. But actually, trading is exchange of stocks. Investment is putting a money in stock and taking it out for a profit. But there is no guarantee of profit. You may even lose the money. So that is the difference between investment and trading. So best thing is to use these terms together and to mean both together. So in order to access a stock exchange as an individual, we need a brokerage account, and the stocks we buy can be parked in a demat account in a electronic format. So we open a demat account. A demat account and a brokerage account or a trading account can be with the two different companies or entities. Then today we are in a position to do the trade using our apps in our smartphone. So basically, how do we make money in stock market? We have to buy something low, then we have to sell it for higher price, right? So how long we hold is a variable. We can immediately buy and immediately sell for high, which is a short term, or it could be a very long term also. See, sometimes this holding a stock can be for generations. Some of us might have inherited some stock from our grandfather. So that might have been invested 50 years back. And now we have to convert into demat mode and invest. So the holding period can be a variable here. So let's understand the key stock market players. We call ourselves an investor or a trader. Actually, we are in the beginner stage. So I would call us as a sheep. Okay. Because we are in the lowest end of the hierarchy. What we know is not much, or our influence also is not much. So it is 90 to 95% of stock market players are sheep. So you and I both are here. Here again, I have made two stages. One is a beginner level and then an intermediate level. Every one of us like to claim that we are at intermediate level because we have spent some time in the stock market. But there's a very good chance that we are still in a beginner level. Typically, sheep tend to lose money by stock trading, because there are so much complexities and uncertainties involved in trading. There is a good chance that we lose money because the risks become higher as the time horizon becomes small in trading. However, even being sheep, we can make money in the stock market. For that, we have to use the sheep techniques, which is basically to ensure that we don't lose money so easily. For example, look at a KSRTC bus. They put some brakes that it cannot go faster than 48 kilometers or 60 kilometers. Similarly, we can make money by borrowing the expertise of money managers by investing in good mutual funds. Just to give an example, I will not talk about IPO because today initial public offering has become very confusing, very very risky also. So I'm skipping that topic today. As your expertise increases, you become a dog. You know, uh, here again 3 to 5% of players in that in capacity, quite experienced, have a high net worth in the invested in the market. They have a strategy, set of techniques. They have diversification. They have a disciplined portfolio management and risk management strategies. You know, they can also do well in stock trading. Okay, they use both fundamental analysis and technical analysis. However, some of the people here can be crooks. Today in social networks, we see so many of those crooks. Do not fall prey to these crooks, because they are actually sheep. They are not even dogs, but they come in the garb of a dog. They say that we are appointed by some top company in the world. They will say that we have made 300% money in the last 3 months. They will say that, worst thing is they say, park your money with us, we'll double it in 1 month. you know or they will come up with offers like, I will give you tips for your trading. It may be futures trading or option trading. Because of my tips, you will make a lot of money. You get to keep 70% and you will pay me 30% back. How it works? The trades will be done by them, not you. That means you are entrusting your money with them. And if they return the money, you are lucky. So a lot of people are falling prey to greed and falling prey for such enticement and losing lakhs of rupees. So if you want to make money in stock market, it should be on your own terms, it should be on your own efforts, and it should be on your own journey. Do not ever entrust your money to third party individuals other than the uh, time tested, proven, certified money managers who are either in mutual funds, reputed mutual funds, not all mutual funds, or some reputed wealth management entities. So you cannot give money to some idiot who makes all kind of claims and loses it for you. Don't fall prey for scams. Now let us go to the next level, wolves. They're hardly 1%. These guys are very smart. They are on the top of the cream of the stock market players. They can even influence the short term stock market sentiments and trends because they invest so much money. you know for example, a hedge fund, you know or in Indian context, it could be a collection of mutual funds, the fund houses. Lakhs of lakhs of uh, thousand crores, or lakhs of crores of money they can bring in or take out. LIC, for example, uh, as much it is known for life insurance policies, it plays big time. Okay, someone is doodling on the. I don't know how to disable that. Okay, uh, these guys can be considered. They can change the sentiment of a stock market short term. You know, Now these are big players. So you watch out, their influences also on a stock market or your investments. Next comes the shepherds. Okay. Uh, is there a way to disable that doodling? I don't know. I'm just trying to see. Maybe next time. Okay. I don't see how it is. Okay. Now, shepherds are those, who are constitute, constituting the stock market ecosystem. Here are the exchanges, brokerage houses, investment bankers, various intermediaries like asset management companies or REITs, clearing houses, depository houses, stock market media, rating agencies, key wealth management. These are all together considered as shepherds. Then there are companies listed in stock exchanges, including large conglomerates like Tata's, Reliance, Adani, Bajaj, and various public sector companies. So they have a tremendous influence on the stock market based on their statements, their business results, their tactics. Similarly, today India, there is an emerging SME business landscape. In fact, being a small and medium enterprise, you can even list in the exchange today. Then also there is so much support for startup universe, angel investment, venture capital investments. So all this together you can consider as shepherds. There is something more than shepherds. I would call them as godlike. They are regulatory bodies like Reserve Bank of India, SEBI, or government because it can influence through national policies, even some international policies like what Feds in US say matters, impacts the global market. Then global market influencers can come from global exchanges, sovereign investment bodies, etc. And so these guys even dictate global economy and global sentiment of the stock markets. So need to keep an eye. So the macroeconomic trends are also influenced by these people. So you cannot make a judgment call on them. You need to have faith that these godlike entities ultimately will try to do the best thing within their means, and because of that you get to sustain and you get to prosper. So this kind of gives you different type of layers, and we are in the very bottom of the pyramid. I hope you can understand that. So we need to have a level of humility as to the limitations of ours. At the same time, we'll have level of aggression because we have a long way to go. So we need to balance both these aspects. Okay, now Indian stock market has become very interestingly attractive. Because India got a shot in the arm in early 90s with certain changes to our monetary and financial policies. Then we got another shot in the arm since 2014 with the NDA government coming into picture. There is so much focus on cleaning the government, cleaning the bureaucracy, increasing the efficiencies of the markets, and bringing more transparency, or bringing more technology and the digital revolution. So much has been done in the last 10 years, you could say, and so much more to come. As a result, our GDP growth rate will increase, and opportunities in the stock markets will go up, and our chances of making money also goes up. Therefore, it is an ideal time to consider Indian stock market. In fact, I would say since last 3 years, it is a golden era. So hopefully it will be there for another 20 years. So we already talked about the risks. Risks are real. We need to manage the risks. So we need to understand the risks. So we'll talk about the risks in more detail in the coming sessions. The risks are not only the inherent risks in the market or our own investment and trading practices, also the certain players who are coming in as intermediaries, can be crooks or can mislead us. We have to watch that risk also. Then there is a risk of economy, there's a risk of governments, there is a socio-economic risk. If a riot happens, that can have an impact, things like that. So there are various type of risk of war, risk of flooding, business failure risks. All these matter. Now, from an individual perspective, since it is so overwhelming, I want to simplify your positioning as to how do you approach your investment and trading. See, basically, as an individual or as a family member, it is your life and it is your family life that is in focus. So you are a provider. You want to ensure certain lifestyle. You want to ensure certain insurances, right? And you want to minimize loans, because if you are uh, taking a loan for a business, hopefully the business gives better returns. The loan is well justified, right? So now you have a dilemma. Should you take a loan for your housing versus your investment? You know, as a beginner, I would always recommend, don't put money in the stock market based on you know borrowed money, because as a beginner you can afford to lose all that money. So you have additional burden of that loan. So a smart businessman will put the money into his business rather than putting into his housing. Only after his business stabilizes, he will buy a house. So, similarly, from a lifestyle perspective, you need to evaluate whether you are better off living in a rented house, or are you better off living in a conservative home with minimal debts, or you ensure a very expensive lifestyle including a great house, but you are always ridden in debt, and if you lose a job, then you are in trouble, you know paying all the debt obligations. Therefore, before even getting into investment, we need to have an idea as how much debt we can afford, right? So probably, I would say one should not have a debt where more than his 20% of his monthly earning needs to be kept aside for debt. Is a general guideline. So, if you have a debt, then you are better off, clearing that debt than bringing that money into stock market. So there are different ways of creating alternate cash flows. Maybe you are already in a job, or you have a side business, or you have some, online, money making gimmicks like YouTube videos. So you can have different cash flow avenues. Got it, no? Then you want to grow your financial wealth, through investments, right? Or real estate, it could be even a real estate investments. So this is the money you can afford to keep aside without having to worry about your lifestyle or, obligations. So you need to come to that level of comfort level. You can do that, even at age of 20s, if you manage your finances properly, right? Or it may take beyond 40 years of life for you to come to that level. So it doesn't matter when you can start, but make sure you are ready to start with your finances, before planning big in your stock market. Then you are going to be very conservative in your growth plans. If you are putting money in stock market, probably it should do better than your, I would say it should do better than your bank interest. It should do even better than your real estate investment, I would say. So typically real estate investments give 10 to 15% return annualized. Maybe you should aim 15 to 20% return in your stock market investments. Sometimes you get unique opportunities. You can take calculated bets for superior returns. Such opportunities came in the last 3 years, where a company became double in its valuation, or a stock price became double. Or sometimes there are very opportunities that can be exploited. Such opportunities come once in a while. For example, an IPO of a reputed agency like IREDA. It could be an IPO, or it could be a policy change that making or a interest rate fall. Various things. Or suddenly a gold price is zooms by 20% in a month. So you need to watch out for such opportunities and exploit that. So these kind of considerations go in parallel, and your money invested needs to be like a pyramid, right? Because as you go up the pyramid, as much is the reward, there is risk also. So you have to manage both of them. So this clarity is based on an individual, and you need to have a level of self realization to do this well. So stock price at any given time varies. So let's just try to understand that. It's a intrinsic value of a stock can change based on its brand, the management strength of the company, record of the company, revenue and profit growth, the profit margins, and earning per share, etc. Okay, why earning per share? A company may make lot of money in terms of earning, but it could be diluting its shares by having more number of shares. Then earning per share is what matters to you. Got it? Huh? Second point, perceived value based on future growth projections, current valuation versus future valuation projections. This can be influenced by macroeconomy. It can be influenced by global trends. Various matters are there. Next one is sentiments and speculations due to certain events, macroeconomic trends, policy changes, political changes, wars, etc. So even sentiments matter. Got it? Speculations also change the stock market. Then supply and demand manipulations happen in the stock market, right? Through certain news and certain campaigns. Actual supply and demand equations in the market, right? Money supply for investment and trading. Government can control the money supply through its monetary policy. Stock market ecosystem maturity, right? So it is a complex system. So we need to understand, keep our ears open for all this, and have a way of assessment. So this is not easy, is what I'm trying to say. So that is more fundamentals. Now let me go to the second part to appreciate the Indian stock market. See, Indian stock market primary aspect is there are two key exchanges, BSE and NSE. And for commodities, there is MCX. I'm right now focusing only on the stock market. Key regulators are RBI and SEBI. Then you have to have a brokerage account, demat account, bank account to move the money into the brokerage account. KYC compliance is required. Taxation considerations are there. And you need to understand the business environment in terms of sector and industry. So this is where I want to spend some time, because it is useful to have this sector knowledge. Now, our Indian stock markets are mentored by S&P, which is a US company. Therefore, the US standard for classification is an influence in arriving our sectors and industries. So US uses Global Industry Classification Standard, GICS. Basically, there are 11 sectors which are comprising of 25 industry groups, then 74 industries, and then 163 sub-industries. US stock market is very well standardized around GICS, whereas Indian stock markets are still evolving. So there is some confusion in the standards. So I would go through different standards. They are overlapping and used. So that is one more confusion for you. So you have to bear with the confusion. So let me talk about BSE standard. See, what BSE has done is it has identified 190 industries, and BSE has approximately 5,000 listed companies. Some 10-15 years back, BSE had 14,000 listed companies, and you can imagine that almost 10,000 of them are duds. Or today the BSE is cleaned up. The benchmark has improved. Such duds have gone away. So today BSE has only 5,000 listed companies. The brand of BSE has improved. So let me try to use this. Okay. I am trying to go to that BSE site. Just bear with me. I may have to change my sharing to that. So I have too many things going here. So I am wondering where is that page. Just hold on. Let me do it again. Okay, I have to do it again. I don't know what happened. So let me click that again. Safety problem. Hyperlink can be harmful. Do you want to continue? Yes. I have said yes. So just bear with me. It's taking some time. See, alternate way is I can just copy that. Okay, it's coming up. So it is coming up. So I had to show that. Just hold on. Let me try to reduce apps here. Just bear with me. Okay, I got the screen. So now I have to share that screen with you. Okay, so now I am sharing that screen. See, this is the BSE India website, list of securities. I have brought you here primarily to show the list of industries. See, these industries, if you go one by one, I hope you can all see this. Uh, okay. So I would urge you to understand these 191 industries, what BSE talks about. So whether it is chemicals or diversified or realty, textiles, this list is huge. Okay. Today I don't see all of that. Yesterday when I checked, it was a big list. Okay, let's. So it is so. So this is one good source to understand the sectors or the industries as defined by BSE. So 191 industries are there. There is a parallel standard by NSE. Okay, so NSE has its own standard. Again, let me share that screen. I'm going back to. There should be a better way of doing it, I guess. Okay, share. Okay, NSE has a different standards. It talks about 12 macroeconomic sectors, which map to 22 sectors, which map to 59 industries, which map to 197 basic industries. But I could not really see whether even NSE itself is using this in a effective manner. So this sounded like more of an academic or a theoretical knowledge, but I wanted to appreciate that thought process here, because when you go to NSC site, you see a lot of academic work, which eventually influences the improvement in the exchange. So let's appreciate their ongoing work. There are around 2,000 companies are there. So out of which approximately 182 securities are in futures and options. And then you can see NSE companies by market capitalization. I'm not going to click that now. Okay. Now, interestingly, more practically, websites like Money Control and ET Money are quite useful to have a classification of the sectors and industry. So you can also see that later. I just wanted to give an overview of sectors as defined by NSE. I am bringing it more for you to appreciate the uh, jargons used maybe in TV channels. For example, when they say commodity sector, it's a loaded term. Commodity sector includes chemicals, construction materials, metals and mining, and forest materials. When they talk about consumer discretionary, again it's loaded term. Automobiles and auto components, consumer durables, textiles, media, entertainment and publication, realty, consumer services. Whereas many other are straightforward. Energy means oil, gas, and consumable fuels. FMCG is fast moving consumer goods. Financial services. Again, industrials is again has two components: construction and capital goods. Utilities has power and utilities. So here again it's a confusion. So in parentheses I called power and utilities for myself. So using utilities at one level and to mean power and utilities, and to mean only utilities without power is confusing. So be aware of such confusions in our terminologies in our market today. So I have gone through how these sectors map to various industries. I will not dwell with that now, because later I learned that it is more of a theoretical knowledge. It's not really useful. So I'm skipping that. So in order to have a good grip in the uh, stock market, we need to have a good understanding of each sector, each industry, and and we need to have a basic overview of each industry, right? Then we need to understand what are the best companies that come under this, and which are the leading companies in this. Then we need to have a meta model of representing the sector knowledge. So this could be our future presentations. I am calling for volunteers who can get into this kind of study and present it. I can help you. I can be your collaborator also, but I need help here. We can present all these industries, 191 industries, or 40 plus sectors. We need a lot of work to do here. So, so that completes the part two. So now I am getting into introduction to fundamental analysis. Let me check time. We have spent 1 hour. We have one more hour to go. So I will speed it up. Okay. So basically today we are getting only an overview. We will get into details in upcoming sessions. So the definition of fundamental analysis is that it is a method of evaluating the intrinsic value of an asset and analyzing the factors that could influence its price in the future. This form of analysis is based on external events and influences, as well as financial statements and industry trends. So, as the definition says, if you are a qualified professional money manager, you should be an expert in fundamental analysis. That means you understand macroeconomy and macroeconomic trends today in the global setup. You understand how the industry works, what are the sectors sectoral influences, and what are the business cyclical aspects. Business cycle goes through, demand and supply variations. Okay. Then you go through a company's potential and its performance through various financial statements. Then you also identify various industry trends based on socio-economic, political, and technology influences, right? So all this become part of fundamental analysis. So we also need to have a good grip. We can learn from the experts. We can do our own study. So today I am going to do more of a walkthrough of a fundamental analysis discussion by Investopedia, mainly because I didn't have time to make slides on this. Then typically, go through what it takes to understand a quarterly report and various financial ratios. Then I will, as a practice, I will go into screener and look into various information available freely to understand a company. So let me click this. It is going to take some time, I guess. So, okay, it's coming up. Good. I had to change the screen to this. I'm not sure. So to be safe, I'm stopping and restarting. Okay. So Investopedia has been a great resource, free resources for learning the concepts. But today, most of its free resources are becoming course contents, so you have to pay for it. But still, there is a lot of useful information here. So go through this fundamental analysis through Investopedia. Okay, so I am just being the highlight. See, you need to understand overall state of the economy, strength of a specific industry, and a financial performance of the company. These are the three important aspects of that. And today with the web, you can get all this information. So the intrinsic value, what is intrinsic value? Stock's current price often does not fully reflect the value of the company when compared to publicly available financial data. That means there is a gap between the value a company enjoys in the market versus its intrinsic value. If the intrinsic value is more than its uh, you know uh, stock price, then it is a hidden value. That's a value that can be unlocked. Or if it is otherwise, it's overvalued, there is a risk of valuation adjustment, and you can lose money because the stock price will be adjusted lower. So that is the concept here. Okay. So I will not get into various aspects of fundamental analysis, except I wanted to show you what it takes. Let me show you something. I forgot to add it to my slides. One should be able to understand the company financials. Okay. So just one sec. Let me see whether I can add that slide now. I have too many things going on my screens. Just bear with me. Okay, I got it here. Yes. Just bear with me. See, understanding a company financials could be a bit complex, but there are a lot of web resources which makes it bit easier. So here is an example I pulled from a web. How to understand an income statement of a business. This is not the only part of the company financials. In the example we go through, we will understand more details. So basically, there is an income statement where in the income statement there is a sales revenue, then cost of goods sold. The difference gives you gross profit. So to the gross profit, you could have other revenues, which is a plus, selling expenses, which is a minus, then administrative expenses. That gives you operating profit, which is earning before interest and tax, or the word EBT is called. Then you have to pay interest expenses. So then it is called profit before tax, or it is basically earning before tax minus EBT. Then you have to pay the tax. Then you get the net income. So this much detail is there between the revenue and the income. So when you refer, so you don't, this net income divided by number of shares floated gives you earning per share. Okay, so this level of understanding is required. And if you go to whether
Can you repeat
if you're
again? Can you repeat this again once? It went a little too fast for me.
okay, so what I'm trying to say is that we are not an accountant or a chartered accountant. However, we need to have the fundamental skills to understand company financials. I am saying there are various web resources which make this very easy for you to understand. You just search for a term and you'll get a lot of pictures which will make it easy. Here, I am giving one example. If you want to understand a company income statement, I am saying this picture gives you a clarity and distinction between what is an income versus gross profit versus operating profit versus profit before tax, okay, or called earnings before tax, versus tax versus net income. So if you notice, the income comes through sales, then there is a cost of the goods sold, right? For example, if you are a grocery store owner, you buy a pencil for 15 rupees, and if you sell that pencil for 25 rupees, your sales revenue is 25 rupees, your cost of goods sold is 15, so your gross profit is 10 rupees, right? But you have some other revenue, maybe you sold some erasers also, then you have some selling expenses because your cost of the rent, etc., at a unit level, it may be 1 paisa or something, your administrative expenses, you get an operating profit. Then you have borrowed money to run that business, you have to pay interest, so that again you have to subtract. So then only you will get profit before taxes. Then government expects you to pay tax on in the profit you have made, and once you pay the tax, the net profit or net income is what you have. And many a time, instead of making a net profit, you can have a net loss also. This clarity is needed about a company financials when it comes to an income statement. But to understand a company financial, it is not just an income statement. You need to have a you need to have a balance sheet view. You need to have a cash flow view. You need to have capital view. You need to have a capital view, and all these are provided together. So I'm directly going to that example. So just hold on with me. So let me bring that screen. So I'm actually going to, so let me stop sharing for a while. Let me straight away go to a screen called, okay, here I have it actually. Just hold on. Okay, I'm ready to go to that screen. Let us now again share that screen. So I'm talking about a screener.in is a very useful uh, resource to understand company financials. You may get similar screens in Yahoo Finance. You may get it in Money Control. You may also get it probably in ET Money. So for today, I am just using. So let us talk about Tata Motors as an example. So let us take Tata Motors. So I hope you can see the screen. See, Tata Motors, basically it talks about certain header information. Its market cap is 3,46,000 crores. Typically in India, any company above 20,000 crores is considered a large cap. So it's a large cap company, a way large cap company. Its current stock price is 946. Okay. And typically the stock price in a year, low was 400 and high was 1066. So that gives its range on an annual low and annual high basis. Then stock PE, price to earning, is 17.2. So we saw an income statement, right? So you can calculate the earning per share. Then you divide the stock price by the earning per share. You get the stock price to earning. You understood? So that gives a kind of a valuation of the market, of the stock in the market. Okay, it's a notional value. It's useful to know. Then book value is that if we today, you know, uh, disassemble or sell the company from an accounting standard, the company is worth 161 rupee per share. But in the market, it is 946 rupees because of various reasons. One, its growth projections, and uh, its income and profit projections, its brand value, all that is, its management maturity, all that is built into this. So approximately price to book value, that is market value divided book value, gives you the premium you are paying for this stock. So it is comparatively around 6 times, in this case. Then dividend yield, because the stock, they share some of the profits in terms of dividends. They may pay once in a year or twice a year or 4 times a year, but effectively for the current stock price basis, it gives you 0.21% interest kind of thing. So that is an additional benefit you have by holding that stock. Then ROCE is more of a performance of the stock. That is return on capital employed. This is bit of an advanced topic. You can skip for now. But it's an indicator of its performance. Then ROE is return on equity. Okay, that on per equity basis, it gives 5.62. This is a reasonable return. Now, what is a face value of a stock? See, let us understand that company needs to be floated with certain amount of capital. So initially it starts with a promoter capital. At that stage itself, it will come up with a notion of a stock. But when it goes to public, it goes public, rather getting listed in the exchange, it dilutes the stocks into far more number of stocks. At that time, it defines a face value. This face value becomes important more in terms of, a baseline for the stock. Typically, the stocks start with a face value of 10 typically. But when they split a stock, or when they give a bonus, when they split a stock, the face value gets divided. For example, this Tata Motors might have started with a face value of 10. Now it is 2. If they split again, it will become 1 rupee. Okay, right? So the
Can
face
you
value.
explain stock price to earnings ratio again? P/E.
Okay. See, price to earning is the premium you are paying for the stock with respect to its earning capability. See, the stock price is not evaluated just by today's realities of the stock. It is future growth projections also. Therefore, people are willing to give higher premium to a good stock, right? So you can see that an earning per share of a Tata Motors share and today's stock price, there is a 17.2 times more you are paying for the stock price is the compared to its earning ability per share, is what I'm saying. So it is kind of a premium you give. So here some more information.
Nataraj, sorry to interrupt you. I think P ratio is also a simple computation of the price of the share divided by EPS. EPS
That's
is
what I
earning
said.
per share. Yeah.
That's all I said.
Computation. Yeah. Okay. Sorry. Okay. Fine.
That's what I said.
Okay.
Okay. So these definitions are available. It's easy to learn. So I am just trying to showcase the landscape of a company fundamental you can easily understand by using screener website. That's all I'm trying to do. I'm not going to teach you everything here, since it's the first time I'm trying to make it comfortable. Then there is a chart summary of how the stock price has moved. You can see how it has moved in a month, 6 months, 1 year, 3 year, 5 year, 10-year window, or a maximum if there is that kind of an information. So for example, if you look at this screen, Tata Motors was around 200 rupees in January, 2021 approximately, right? So today it is near 1,000 rupees. So it has gone almost 5 times in 3 years. That is an amazing performance. So if you had bought Tata Motors 3 years back and sat on it, you would have made 5 times the money by selling it today, right? So that is what it tells about the stock performance. Okay. Now here there is a P ratio. How the P ratio varies? Let's talk about in the last 1 year how it is varies. Because the quarterly results come, then there is a jerk in the P ratios, or if certain events like bonus shares happen or splits happen. So today, so Tata Motors went up to 17 P ratio. It's now below 16. So those things you can understand. This is the screener summary of the stock. It says company is expected to give good quarter. It also gives some bad aspects. Stock is trading at 5.86 times book value, so it's expensive. Company has delivered poor sales growth of 3.48% over past 5 years, right? Company has a low return on equity of minus 3.84 over last 3 years. So because the Tata Motors is very highly valued, there may be some disadvantages. So there are certain things that's happening in the background which you will not see in the financial statements. For example, Tata Motors, Tata Motors may have lot of things going on in its business plans, which you can read up in the annual report or investor presentations. They're also an important factors in the stock price. We'll get some of that. Now, when you look at a particular company, screener allows you to evaluate it with its peers. In this peer comparison, if you look at it, Tata Motors is compared with Ashok Leyland. Tata Motors DVR is more of a Tata Motors stock, but with no voting rights, so it costs less. So we'll ignore that. Electra Green Tech, which is all EV buses, etc. Force Motors and SML Isuzu. So these are compare. Let us compare with Ashok Leyland. Ashok Leyland is around 161. Ashok Leyland has more PE ratio. Market cap of Ashok Leyland is very much less compared to Tata. It's a smaller company. Ashok Leyland gives a better dividend per share. Then net quarterly revenue again is less than 1/10 for Ashok Leyland. The profit, if you notice, it is much higher in percentage wise. Now, what is NP? I forgot. Net profit. Sorry, this is net profit. Sorry, I said something else. This is the profit variation. Profit. This is the profit change. Tata Motors came up with 139.98% change in its quarterly. That means the quarterly profits are growing at a much higher rate than Ashok Leyland. That is a very positive for Tata Motors. Total sales for the quarter was 110,000 crores. That is a lot of money. Whereas for Ashok Leyland, it is how many digits? At least 100 times less. Got it, no? So again, quarterly sales growth went up by 24%, but profit went up by 139%. That means there is so much profit improvement possibility just by improving the sales. That's why people are giving very high valuation for this stock. Okay, so that kind of comparison you can do. Next section is quarterly results. So we saw a simple statement earlier. Here, the sales are given on a quarterly basis from December 2020 to December 2023. So from 75,000 crores, it is 110,000 crores. Now, there are more details. Sales has year-on-year sales growth, expenses, all this matters. I'm not going to get into that. Then operating profit margin percentage, other income, interest, depreciation. From an insight-based perspective, we will look at these statements much more in detail and clarity later. I'm just introducing what it is right now. So, see, operating profit also in the last 3 years, it is from 12,133 to 15,409. So on paper, it's not. It's a nominal growth. Profit before tax, it is looking slightly better, almost doubling. Net profit has 3 times. That is why, see, net profit has become close to 2.5 times. Let's say. But this net profit growth projection for the next 3 years is very high. That's why a much higher valuation is given to this. Earning per shares today is 21.14. And if you notice certain quarters, Tata Motors reported losses. That's why its stock prices was low. So a company go through such cycles. So that is what you can understand here. That is from a quarterly results perspective. Then it is a pure profit and loss statements. Here they have done it more from yearly basis. So from March 2012 to March 2023. This is more from an annual reporting perspective. Again, sales expense, that was quarterly. This is more from annual basis. Okay. So both views are useful. Then various percentages you can see. compounded sales growth, profit growth, stock price, how it has varied. For example, profit growth, TTM, that is 496%. That is quarters to quarter, I guess, trailing quarters or something. In 1 year, stock price has almost more than doubled. So these numbers, we need to have it in our fingertips to appreciate the intrinsic value of the company and our opportunities to make money by investing in this company. So this learning has to happen. Is all the statement I am making today. Then comes the balance sheet, which is assets and liabilities view. Equity capital is the money that is invested through equity. It's available in equity. Then company has certain reserves that are growing. That's good. Borrowings, the company borrowings is reducing now in terms of annually basis. Liabilities typically go along with the assets. So what is important in liabilities is it's how it compares with the assets. Okay. For example, fixed assets. If the company fixed asset is going up, it's an indication that an investment is happening. Investment is happening in terms of land, building, plant machinery, equipments, computers, furnitures, vehicles, intangibles, other fixed assets. In underlying accounting in the background, there will be some depreciations also. Okay, so these are all assets and liabilities. I am skipping the details for now. If necessary, we will come back with discussions here. But typically, a company investment can be evaluated by the fixed asset. For example, total fixed asset in 2012 was 44,360 crores. Today it is 132 or 140,145. So these investments is kind of an indication that these investments will pay off in terms of better revenues and profits, is what we need to keep in mind. Then there are cash flows. Cash flow is important. That is to run the company, cash from operating activity, investing activity, financing activity. Again, there are a lot of details here, where the cash flow happens in terms of plus or minus, working capital, net cash flow. So today, net cash flow is actually negative. Okay. Though it is negative, there are profits there. So it's marginal. So of course, there are borrowings to manage that. So then there are ratios. These ratios talk about sustainability. Debtor dates. I am not in a position to talk about it in detail today. Debtor days, inventory days, days payable, cash conversion cycle. I am unable to say that because I not spent time on this. But these are sustainability indices in terms of the debt side, inventory side, cash conversion side. These are also useful. Then comes the shareholding pattern. The shareholding pattern talks about the stability of the investment. You want to see a promoter's stocks being stable. If the promoter keeps selling the stock or putting the stock into a pledge to get the debt, it could be quite a risky situation. Typically, any business with the promoter share more than 40% is good situation to have. You can also see the foreign investors investment in the stock, which is 18.62%. Then domestic investors like mutual funds, 17.25%. Government investment and public is around 17.6. This is a kind of a healthy mix here. Now, the last section also is very important, which are various documents. You can understand the annual report. To understand a company in full detail, we should read an annual report. So last annual report is financial year 2023. And another thing that's useful is how they make presentation. See, the annual report gives you certain insights as to how company is planning to grow in a better fashion, expand its markets, expands its profitability, expands its offerings. So that gives you a better grip. If you don't have patience, you can also go through the investor presentations. Okay, so here this was done in February. So let me kind of look at this. It is much easier, but please understand that such a presentation, while it gives you clarity, it could be what is a bit biased because it is made by the company. So let me go through that. Just one second. How it looks, that's all I'm going to highlight today. Okay, so this is, there are some disclaimers they have to make. Then their products portfolio, their revenue statements, earnings statements. Okay, then this is some highlights of the performances. Okay, different segments, geographies, right? How the cash flow is influenced. So then some intangibles also they discuss about their future plans. So they are talking about their various product offerings, commercial vehicles. So you get to understand the company not only from financial perspective, even from a management and a leadership perspective. And they make some forward-looking statements. You can, but there will be some disclaimers here, but it is useful for you to get a sense of grip on what Tata Motors is, how much you can trust it, how much you can bet on it, and how is the probability you can make money with it in the next 3 years. If not at the same rate like last 3 years, maybe it could be a reasonable return. So these kind of details are available. So basically, the summary here is that just going through a company information in a screener, we can do a good grip, get a good grip of the fundamental aspect of the company. To this, you need to add what you read in the newspaper, what you listen to in channels like CNBC TV 18, the various researches you get from brokerage companies or websites like Money Control. So you will become strong with respect to your understanding of fundamental aspect of the company is what I want to say. I think I'm running short of time. So now, I will complete fundamental analysis to here and rush through the technical analysis. Just give me a minute where I have. Just one sec. Just one sec. I'm trying to bring my screens back. Okay, I got it. Back. I'm doing this presentation after a long time, so I'm not being quick enough. Bear with me. So, fundamental analysis and technical analysis can be two different ends of the spectrum, you can say. See, fundamental analysis believes in the intrinsic value of the company, compares it with the valuation that the stocks enjoys in the market today, and the projection of the intrinsic value going up or down, and based on the difference between the today's price and the intrinsic value projection, you get a projected value of the company in future, and therefore you make investment decisions. So in a way, it is a potential aspect of the company. Here, technical analysis more of the kinetic aspect, that is how the stock price is moving in the market, in a timely fashion. So technical analysis definition is that it is a trading discipline employed to evaluate investments and identify trading opportunities in price trends and patterns seen on charts. Technical analysts believe past trading activity and price changes of a security can be valuable indicators of the security's future price movements. See, what it means is that, let's say, Tata Motors example we saw, the stock price became 3 times, right? So independent of fundamental analysis, just by looking at the price trends of the Tata Motors, as long as the trends continue, as long as there are no reversal signals, a technical analyst says keep on investing in Tata Motors based on how it is behaving in the stock market. Got it, no? So for this, you need to become an expert in reading charts, right? So I am not going to get into details of technical analysis. Therefore, rather I will jump into the how a technical analysis happens through charts. So I will straight away go into charts. So let me bring up a chart I typically use for my own trading. I preserve those pages because I don't want to spend a lot of time to. Okay. So I'm trying to bring one chart here. Let me start sharing that chart. I hope I will share screen. Will it come? So okay, it is coming. Good. Okay. So can you all see the chart here? I am using trading view chart here. Now let me talk about the components of the chart. Okay. So a chart is a depiction of the stock price on a particular time interval we select. So here the chart is trying to come up again. Just hold on. This because I have too many things going on. So let me kill certain things here. Okay. So for some reason that chart screen is taking time. So give me some time here. I'm trying to refresh it. I don't know whether it is because the trading view is in some maintenance. Let me see whether I can get something else, some other chart. Also, I will try to close a lot of windows here. It could be because I have too many windows open here. Just hold on. I'm done. Closing various windows. With that, I think it will improve. But it is taking time even to close the windows. So please bear with me. So I am closing almost 24 windows in my browser. With Zoom running in the background, I think it is becoming hard. So hopefully this will free up the resources. Okay. Okay. So I'm going back to that chart. Okay, finally I got the chart. I hope you can see the chart now. Okay. Can you see this chart? I hope so. I'm getting a Nifty chart here. This is the Nifty futures chart. Okay. Now let me talk about various aspects of the chart here. See, the chart here is in terms of time interval of 1 minute. So you can appreciate the stock price. In this case, it's an index. How it moves. Index is a set of stocks in terms of explaining how the chart works. So this is 1 minute. So you can get a different view if you ask for a 5 minutes interval. Okay. Then next one is 15 minutes intervals. So like that, you can get a picture as to how the price moves for an 1 hour interval. It can go in terms of 1 day intervals. And then you can also go by 1 week or 1 month intervals. So depending on your investment horizon, you need to use the right time units in your chart. If you are a long-term investor, you need to have an ability to predict how the script will move in terms of a monthly chart, a weekly chart, and a daily chart. Whereas if you are a momentum trader where you want to make money in its short-term moves, you would like even a chart of 1 minute versus 15 minutes. See, now the trends are more volatile as the timeline shrinks. So let me show that this is a 1 minute chart of Nifty. So this is the Nifty in the last session. So you can see it started somewhere here, I guess. Market open, it went up, then there was some corrections. No, I cannot really clearly see the timelines here. So I will put 1 day, therefore. See, this is Nifty's chart in 1 minute yesterday. 1 day, see, it opened market here, went up a bit, then fell through it, tried to recover, again fell, went bottom here, then started recovery, again fell through, recovery, again fell through. So there is so much volatility when you compress the timeline. Therefore, as a trader, as a short-term trader, you are signing up for too much of risk because the stock price is varying because of too many variations of supply demand equations and whatever is happening in terms of sentiment, speculations, and other influences. Whereas if you are a long-term investor, let's say you want to hold a Nifty index for 10 years. See, this is how it looks. So let's say in 2016 you came in, you bought a Nifty index at 7,192, and today you are holding, even after 8 years, it is 21,996. So it is 3 times. It has gone 3 times, except for some times intervals. There have been corrections, but long-term view of the market is keep going up even with corrections. That's why they say, as a beginner, you have a better chance to make long-term bets than the short-term bets. But return on investments tend to be more in short-term bets if you are successful. For example, here the Nifty in 8 years gave you 3 times returns. That is very good. 3 times returns in 8 years. Whereas, let's say you are capable of getting 1% return in a short-term game in a day. That is 200% return because there are 200 trading days. I am talking about average return, which is making it 3 times in a year. So that is the lure of short-term player. But to become a short-term player, you have to become a superior expert. Your risk management needs to be much better. So that is what the technical analysis helps you to do. So I am going for 1 minute, and I prefer to go for a stock. And for some reason, this other diagrams are not coming. Okay. Okay, I'm stuck with Nifty therefore. Okay. So let us talk about how to make sense of a graph or a chart like this. So now this chart can be drawn in different fashions. Here it is drawn in terms of candles. Candle is a basic unit of price movement. So here a candle is red if it started with high price and ended with low price. A candle is green if it started with low price, it ended with high price. Okay, for that time interval. Now, a candle can have a wick at both sides. What it means is, remember, it's a 1 minute interval. During this 1 minute interval, while this gives the end price because it's a red candle, this gives a starting price. The top wick gives the highest price. The bottom wick gives the lowest price. That means during this 1 minute, the stock price went lower than it ended with, and it went higher than it started with. So the next one, this green candle, doesn't have a wick in the bottom. Okay, so So it started here, it ended here, and its highest price was here. So the lowest price is same as the start price, is what it means. Now, because of how the candles are arranged, you can make certain patterns, and those patterns tell you as to how likely the stock is going to behave in future, right? So, for example, if you have to make a projection of the stock as to how it opens on a Monday morning, you go to a 15-minute stock, here a 15 minutes. So in this 15 minute, if you notice that there are other indicators, there are hundreds of indicators, which are basically the commentaries of the price movement from different angles. We will get into detail in next session. So to become an expert in a technical analysis, you need to understand the spirit of these indicators, and you should know how to use them, right? Like a doctor knows how to use a complicated instrument and reads the readings and makes the projections about the health of the patient. So that is very important here. So here, for example, I have some experience here. You see these things, this is the price movement, the volume associated with the price movement. Okay. See, one simple concept in trend analysis is the momentum of the stock. Momentum is the what is the price action of the stock in that interval and what is its volume. So this price action into volume gives you momentum. In fact, there is a indicator called a momentum or a PV. You can put that also. So when a stock price goes down, momentum is negative. When the stock price goes up, momentum is positive. So the series of green bars, that is positive momentum bars versus red momentum bars, tells you how it looks. So just looking at this graph, okay, keeping all other variables same, I would say the stock price is going to be neutral on Monday morning. But the stock price need not behave on Monday morning just based on what this chart says. It could be based on so many things that happen today, tomorrow, and before market open on Monday. Therefore, you can use technical analysis as to the trend of a stock in terms of its price, volume movements, and the momentum and other indicators. You also use fundamental analysis. That is, if Tata Motors is going to come up with new initiatives on EV batteries or EV vehicles, there is always a bullishness as to the stock price. So that can be your safety valve. And let's say there is a news that comes on Monday morning, and you hear that they have decided to make an IPO of some section of the company or something. That day, the stock price will go. So you have to use fundamental analysis, technical analysis, and other variables, speculations, news, all together to predict a movement. And predicting a movement in a short term is much more hard than in a longer period. Therefore, as a beginner, you need to play in a longer time intervals, So I would say that maybe you should not go below daily. You need to look at daily, So this is the daily chart of Nifty. It is looking tired, meaning I would say that Nifty can fall on Monday. See, Nifty is very likely to fall on Monday if all other variables are same, which means we are going through a correction phase right now. It's a sideways movement correction, but with a downward bias. That you can feel by looking at the price movements. there is far more advanced topics in technical analysis. Today, my job is just to introduce. So I will end it here. So, and open it for Q&A. But before going to Q&A, though I am a bit running late, I want to talk about various sources, because Investopedia does have still some free learning materials. Zero the Varsity has lot of materials. It may be bit lengthy, but it is worth going. Then Khan Academy has certain topics related to economics, finance domain, that is useful. In Quora, you get a lot of question and answers, which quickly gives you some clarities. Then in YouTube, you can go to certain trusted content creators. One I am very impressed is Akshay Srivastava. He is an IIM and IIT graduate. So he has quite a depth in his presentations, and it's very useful in learning, because more than learning value, it also gives insights and inspirations. I wanted to show one Quora here, because just to demonstrate how Quora can be useful. And I was, my learning became quite quick here yesterday, just looking for some samples. So now I'm trying to bring that here. Okay. I want to share that screen, Quora screen. I'm searching for it. Where is that Quora screen? Okay. Okay, I'm a bit struggling here. Okay, I got it. Okay. See, this is Quora. How can I learn everything about stocks and stock market from scratch? One guy, Indrajit Shantaraj, has written a good answer. Let me show that answer. In this answer, he has tried to explain type of stock market trading. From a time frame perspective, it is scalping, day trading, positional trading, and investment. From a technical aspect, it's a breakout trading, price action trading, swing trading, indicator trading. Now, just reading this, you become present to various options. Now, in my case, because I have very limited resources invested, and I am very hungry to make money, I am actually playing with scalping and day trading. I have some money in positional trading, but they're all under loss because of the recent correction. If I sit tight for next 2-3 months, they'll come to profit zone. But until then, that money is locked. Okay. And the investment side, I am investing in mutual funds. Got it, no? Mainly the profits that come from my scalping and day trading. Technical side, you can understand a breakout based on how the price volume moves. Then price action moving trading is something between in a sideways market, you can buy low and sell high. So you can see the support and resistance levels and play within that. Okay. That is the swing trading. I'm sorry. Swing trading is playing within two limits of support level and resistance level, whereas price action trading is how the price actions on a chart tells you whether it's investment worthy or not for a particular period. Then indicator trading, certain indicators, like if the RSI moves in a certain way, if the MACD moves in certain way, you can make trading decisions. So that kind of explanation in the example is given here. Okay. So Quora also is quite a good place. Not everything here is useful. As you read, you can differentiate between useful information and certain bullshit propaganda and outright promotions. Got it? Huh? So everything comes with that kind of caveat wherever you go. So stock market is, therefore learning is as much you are getting clarity, that much you are getting confusions and misinformation. So you need to be okay with that. Then there is something happening in India today, government activism with respect to taking the country towards developed country in next 2 decades uh, is going on. There are so many things happening, digital revolution happening. So it is very interesting to track certain government programs and therefore make some assessment how it will morph the business ecosystem, what kind of reforms are coming, what kind of efficiencies are coming, what kind of comfort level we can assume. So keep an eye. And the first one is very useful. India Brand Equity Foundation is a good place you can learn about various sectors. I don't have time to show that. So I am jumping into question and answers right away. And I hope to remove unmute yourself if you can. I hope. So that is the end of presentation. We'll spend some 10 minutes because we're already over time. Are there any questions, please? Just hold on. Do I need to say enable? Also, please leave comments in chat as to what do you want to see in the upcoming sessions. If I have to talk, I will have only one session per month. But if there are more volunteers coming up,